Imagine you're just chilling at a coffee shop. Suddenly, a friend tells you he just made 5 million rupiah from buying stocks. You smile, nod, but deep inside, you're thinking, how does this stock market thing really work? If you've ever had that thought, you're not alone. A lot of people feel like the stock market is some elite world, only for smart people, rich people, or insiders. But that's not true. The stock market is a place where anyone can become a part owner of big companies like Tokopedia, BCA, or even Unilever. The problem is, with all the jargon and confusing news out there, most people feel overwhelmed before they even begin. In this video, we'll break down how the stock market works, in a relaxed, easy-to-understand way. We'll talk about the history, the mechanics behind the scenes, how people make money, and also why many end up losing. We'll even touch on mindset traps and common mistakes that catch people off guard. So grab your coffee or tea, because our journey through the stock market starts now. And by the end of this video, you'll know more than most people. The stock market isn't some new thing. It's been around for over 400 years. It all started in Amsterdam in the early 17th century. The Dutch East India Company, known as VOC, was the first company to sell shares to the public. They raised money from ordinary people to fund voyages and the spice trade. The idea was simple. You could own a small part of a company by buying a piece of paper, and if the company made money, you got a share of it. That's the origin of the modern stock. From there, the concept spread globally. In America, the modern stock market took off in the early 20th century, and it hit a major turning point during the crash of 1929, known as the Great Depression. That disaster taught the world an expensive lesson. The stock market can make you rich fast, but it can also wipe you out just as quickly. In Indonesia, the Jakarta Stock Exchange officially opened in 1977. At first, it was a game for the elite. But today, with just 100,000 rupiah, anyone can start investing using apps on their phone. The stock market is more open than ever, but the public's understanding of how it works? Still way behind. So here's a common question. Why do stock prices move up and down every day? The company doesn't change overnight, right? Well, the short answer is called expectation. The stock market is driven by what people think will happen in the future. Let's say a tech company is losing money today, but investors believe it will explode in 5 years. That belief alone can make the stock price rise now. On the flip side, a strong company might fall just because of bad news or rumors. Stock prices are ultimately ruled by supply and demand. If more people want to buy a stock, the price goes up. If more people want to sell, it goes down. But this isn't a traditional market. Sometimes the tiniest things can have a big effect, like a tweet from a billionaire, global conflict, or a new CEO. Remember when Elon Musk tweeted about Dogecoin and the price skyrocketed? The stock market is like a mirror of mass psychology. It's not always about who's the smartest. It's about who stays calm, sees trends early, and doesn't panic. So how exactly do people make money from stocks? There are two main ways: capital gains and dividends. Capital gains are profits from the difference between buying and selling prices. Let's say you buy a stock for 2,000 rupiah and sell it for 3,500. You make a profit of 1,500 per share. Dividends, on the other hand, are portions of the company's profits distributed to shareholders. Some companies pay dividends regularly, like BCA. Others reinvest the profits for future growth. Smart investors often look for both, stocks that pay dividends and also have room to grow in price. But this isn't gambling. There's research, analysis, and strategy involved. Successful investors don't just buy randomly and hope. They know when they're buying, and they stick to a plan. Sadly, many beginners fall into the same traps over and over. For example, getting lured into penny stocks that are artificially pumped up. These stocks look cheap, rise fast, and crash even faster. Or jumping in just because of FOMO, fear of missing out. They see others getting rich, and they rush in without understanding anything. Some panic when the price drops a little, and they sell at a loss, when just a bit of patience could have saved them. Others invest with no plan. They buy today, but don't know when to sell or why they even bought it. In the end, they regret. That's why it's so important to learn before you leap. The stock market isn't a get-rich-quick machine. But with the right knowledge, it can be one of the most powerful financial tools in the modern world. If you want to succeed in the stock market, you need the right mindset. First, stop thinking short-term. The wealthiest investors think long-term. They buy strong companies and let their value grow over 5 to 10 years. Second, be consistent and disciplined. Investing is like planting a tree. You can't expect fruit the next morning, but if you water it, give it time, and stay patient, the results can be incredible. Third, never stop learning. Markets change, trends shift, the global economy evolves. The best investors are lifelong students. And finally, never put all your money in stocks. Diversify. The stock market is a quiet vehicle, not the quiet destination. Use it wisely. If you enjoy content like this, hit the subscribe and like button to support this channel, and share it with a friend who needs insights like these. So where do all these stock transactions actually happen? Behind the scenes, there's a place called the Orange Stock Exchange. In Indonesia, it's known as BEI, the Indonesia Stock Exchange. In the US, there's the New York Stock Exchange and NASDAQ. Think of it like a big digital marketplace. Every second, thousands of buyers and sellers are connected through brokers and trading systems. You, sitting at home, might click buy on your phone. That order travels through your broker to the stock exchange, gets matched with someone selling, and boom, the transaction is complete in milliseconds. It's not magic, it's technology. There are also BEI's market makers, firms that make sure there's always liquidity in the market. If there are no buyers or sellers at a given moment, these market makers jump in to keep things moving. Behind this seamless experience is a complex network of servers, regulations, financial institutions, and surveillance systems. Every stock has a ticker symbol, a short code used to identify it. For example, BBRI for Bank BRI or AAPL for Apple. These tickers flash on screens, showing real-time price movements every second. This is why stock trading feels like a living, breathing system. Because it is. It reacts to global news, political changes, earnings reports, even interest rate changes from central banks. Understanding the role of the stock exchange helps you see that investing isn't just clicking buy. It's entering a massive financial ecosystem with rules, risks, and rhythms. While retail investors like us are growing in number, the big movers in the stock market are still Sun institutions. We're talking mutual funds, pension funds, hedge funds, and foreign investors. These players manage billions of dollars. They can move the market with just a single trade. They often use algorithms, computer programs that analyze data and make trades automatically. Some of these trades happen in milliseconds, what we call high-frequency trading. This creates ultra-fast movement in prices. As a retail investor, it's almost impossible to beat them at speed, but you don't need to. Your edge is patience and long-term thinking. Institutions have performance pressure. They have to show results every quarter. You don't. You can stay invested in a great company for 5 years without worrying about daily noise. That's your superpower. But you still need to pay attention to what the big players are doing. When foreign funds pour into a country, stock prices tend to rise. When they pull out, prices usually fall. So watching institutional flow is like checking the tide before you sail. Let's talk about some stock market events that often confuse people. First, IPO or initial public offering. This is when a private company goes public and sells its shares on the stock exchange for the first time. It's like a debut, a company stepping onto the world stage. Some IPOs explode in value, like GoTo or Bukalapak. Others fall flat. The key is to understand that an IPO is not a guarantee of profit. It's just the beginning of a company's public life. Next, stock splits. When a company splits its stock, it's basically cutting the price per share and giving you more shares. If you owned one share at 10,000 rupiah and it splits 2 for 1, now you have 2 shares worth 5,000 each. Your total value stays the same. It just becomes more liquid for smaller investors. Then there's stock buybacks. This is when a company uses its own cash to buy back its shares from the market. It reduces the number of shares in circulation, which can increase the stock price. It also signals confidence. The company believes its stock is undervalued. Understanding these events helps you react wisely when they show up in the news. They're part of how the market works, not random. Part 10. What drives a company's stock value in the long run? In the short term, stock prices can swing like crazy. But in the long run, one thing matters most: earnings. A company that consistently makes more profit over time will see its stock price grow. This is why investors study earnings reports. Those quarterly updates where companies reveal how they're doing. They look at revenue, expenses, debt, profit margins, and growth rates. They ask, is this company growing sustainably? Is it managing its costs? Does it have a competitive edge? Warren Buffett, one of the world's greatest investors, always says, buy a business, not a stock. He looks at companies the way someone might buy a farm or a small shop. Can it produce income year after year? That's the mindset that wins in the stock market. And it's what separates investing from speculating. If you enjoy content like this, Hit the subscribe and like button to support this channel, and share it with a friend who needs insights like these. Now let's talk about something that moves the stock market more than logic ever could. Yep, human emotion is one of the biggest forces behind every boom and bust in the market. When the market is booming, people get greedy. They think prices will keep going up forever. They throw in more money, often without thinking. That's when bubbles start to form, like the dot-com bubble in the early 2000s, or the crypto rush in 2021. Eventually, reality hits. A big event or correction happens and suddenly, panic. People sell in fear. They don't want to be the last one holding the bag. Prices crash. Not always because companies are bad, but because of pure emotional reaction. This creates something called herd mentality. It's when investors blindly follow the crowd, up or down. They don't stop to think, they just react. This is why experienced investors always say, be fearful when others are greedy, and greedy when others are fearful. Understanding market psychology can be more powerful than understanding technical indicators. Because behind every stock chart is a crowd of humans, all reacting to their own hopes and fears. If you want to succeed in investing, learn to manage your own emotions at first. That alone puts you ahead of most people. Let's step back a little. What is the stock market really, Mavre? What's its true purpose in the bigger picture? The answer is simple: to help companies raise capital and to help people grow wealth. When a company wants to expand, open new branches, launch new products, enter new markets, it needs funding. Instead of taking massive loans, they can go public and offer shares. In return, investors get the chance to grow their money alongside the company. It's a buy-win-win system, in theory. The stock market channels money from people with capital to businesses with ideas. It helps fund innovation, job creation, and economic growth. This is why stock markets are considered vital to modern economies. But somewhere along the way, many people started treating it like a casino. Short-term gambling replaced long-term investing. Hype took over logic. That's why it's important to realign with the stock market's original mission. It's not just a place to get rich fast. It's a bridge between capital and creation, between vision and value. If more people treated it that way, we'd see better outcomes, both for investors and for the economy. So next time you open your trading app, remember, you're not just buying a stock. You're buying a piece of a business and the future it's trying to build. If you enjoy content like this, hit the subscribe and like button to support this channel and share it with a friend who needs insight.